And we're back. This is one of the highly requested talking videos that you guys have been asking us about, and that's about loans. What did we learn in the loan process, and how did we specifically do our loans? All right. And there is a lot of nuance to this. There's a lot of things that you can only find out by going through the process, and we're more than happy to share to save some of you guys some of the headaches we had. Also to help you plan. We had kind of the wrong idea of how the loan process works. So we thought, if you have 20% down in good credit, then you'll be good to go to get a loan. That's not how it works at all. And if that's how you're planning, like us, to do your traveling, then you're gonna be in for a rude awakening. So here's how it really works. So first of all, you need to qualify for the loan. The qualifications for the loan are way more nuanced than it seems, even if you go to the different lenders' sites. So basically, if you want to be able to qualify for a boat loan, you need to have at least 20% down in cash of the boat value. So let's say a $100,000 boat, you need $20,000 in cash. You also need good credit score, that's obvious, and a healthy DTI. DTI means debt to income ratio. Different lenders have different requirements around the DTI ratio that you can have. How to figure out your debt to income ratio is you figure out how much money you spend monthly on your debt, say your car or your house or your whatever, and how much money monthly you make. If you're spending half of your money every month that you make on your debt, then your debt to income ratio is 50%, and you're going to have a hard time getting a loan for that with that kind of ratio. Ideally, I think you want to be under 40 or 30 even better. Our debt to income ratio is one of our strongest things, so that was never really a big sweat for us, but you do need to be aware that the debt to income ratio is a big deal and can disqualify you. So when talking to lenders, ask them what debt to income ratio they prefer. Also, they will talk about the debt to income ratio after the loan. So if you for really easy numbers, if you're making $1,000 a month and you're spending $250 a month on your debt, then your debt to income ratio is 25%. But if your boat loan is going to cost $500 a month, then your debt to income ratio after the boat loan would be, you have a 75% debt to income ratio. So it's not only your debt to income ratio before the loan, it's also your debt to income ratio after the loan. The lenders care about both of those. So they basically don't want you to get too big of a loan that you then can't pay for. Another one, and this is the one honestly that got us the worst, is that the lenders were looking for boat loans, they are looking for a previous installment loan history that's at least half of the amount of the boat loan that you're getting. So let me go through that. If you're trying to get a boat loan, so the actual loan amount is $100,000. If you're trying to get a $100,000 loan, then they expect that you've had at least a $50,000 loan previously, and it's an installment loan, so one that you pay on monthly, not an open-ended like a credit card or something like that. And this is kind of a big deal, because basically, unless you've bought a house before, there's no way that you're going to have a previous installment loan history that's half a big loan. So initially we were looking to get maybe $150,000 or $200,000 loan. If we had gone for a $200,000 loan, that means we would have had to have had a $100,000 loan previously. And they want to see at least 6 months payment history on that previous loan, but that's like the minimum. They're really looking for 18 months of history on that previous loan. So that was our biggest disqualifier, because our previous largest loan history, since we never bought a house, was my school debt, and that was only about $20,000. For the I had multiple loans, so the largest of them was about $20,000. That meant the largest boat loan that we could get was about $40,000. And that really wasn't going to get us very far. Two other things that they care about is how long have you worked at your current job and how long have you lived at your current address. Both of those are important. They're basically looking for stability. And for us, because we lived in apartments every year, we hadn't really lived in a place for a long time. And another thing is, I had only been working at my job for about a year and 2 months when we first started the loan process. By the time we actually got our loans, I had been working at my job for like 19 months or something like that, more than a year and a half, and we had been at our residence for almost a year and a half. Those aren't necessarily hard rules, but you have to be stellar in all of the other categories if you're going to get around the having lived in a place a short amount of time and having a job. The job one I think is more important. They want to see that your income is stable. Also, with certain lenders, after you get past a certain amount of loan, for instance, one of them was $150,000. So if you got a loan that was $150,000 or more, then there was extra requirements with regard to your money. They required that you had either 18 months of debt payments liquid in cash in the bank, or that your net worth was 2.5 times the loan amount. So let's rewind there. The first requirement is that you have 18 months of debt payments. So for instance, on a $150,000 loan, just pretend that your monthly payment was $1,000. They would require that you have $18,000 in cash in the bank in addition to your down payment. So whatever your down payment is doesn't count. They want to see, basically, after you buy the boat, you can pay for it for 18 months in cash. So it's either that or that your net worth is 2.5 times the loan amount. So again, if you're getting a $150,000 loan, then they want to see that your net worth is $375,000 for a $150,000 loan. Again, we didn't qualify on either of those for the $150,000 or more loan. Now, for this particular lender, which this is Essex in this case, at least at the time of speaking, if you got a $149,000 loan, those two, either the liquidity requirement or the net worth requirement didn't actually apply. So you need to know, the larger the loan you get, sometimes there's extra stipulations with regard to the qualifications. Those are a lot of the rules that they don't tell you about, but there's some other more soft rules that are important to know with regard to qualifying for a loan. One of them is you need to have a coherent story around what you're doing. You can't be wishy-washy. When you talk to the lender, they want to know where are you going to put the boat. That doesn't have to be set in stone, but they want to hear you come up with an answer, like, we're going to put it at this marina, either, this is our first choice marina, this is our second choice marina. We're going to visit it, 2 times a month or every weekend. We're going to go sailing. We're going to take it out, during Christmas. Or they want to hear your plan, and they want to understand. Like I said, these are soft rules. They want to know that you have some. You're not wishy-washy, like, oh yeah, we're gonna buy a boat and like we'll figure it out. They don't want to hear that. Even if that's what you're doing, which is kind of honestly what we were doing, you need a more coherent story than that. And again, you don't have to lie. You just need something that's your first plan, and if your plans change, it's completely fine. Another thing to know is with regard to liveaboards. Some lenders are okay with liveaboards, some lenders are not okay with liveaboards. People have told us different advice. Basically, if you're going to be on the boat more than 6 months out of the year, then you're considered a liveaboard for most people. For us, this wasn't a problem because we got our loan through Essex and they don't care. But some of the other lenders definitely do care and don't really lend to liveaboards. So you just need to know what the lender's expecting, and maybe you'll figure out how to answer your own questions with regard to your liveaboard status or not. Another thing is the lenders do not like absentee owners. Don't say that you're going to buy, if you live in California, don't say that you're going to buy a boat in the Chesapeake Bay and see it once a year. They don't like that. They want you to be taking care of it because they're going to have a lien on the boat while you're paying it off. They want you to care about the boat, because if you default on it and you just let the boat sink, then it's going to be hard for them to sell the boat. So they want to make sure that you're going to actually be taking care of your boat. So make sure your story doesn't sound like you're going to be an absentee owner. Another thing to realize with regard to qualifying for loans is the smaller your loan, the lower priority you're going to get. Our loan with Essex was only $40,000, and we'll get into how we did that. But with other people, when we were shopping around, the smaller they're looking for $1 million loans or $700,000 loans. If you're like $100,000 or $200,000 or less, then the loan brokers get less commission out of you. So you're going to take a little bit of a back seat, and that's just something to be expected. Also, another restriction with regard to qualifying for a loan, if you're buying a boat that's outside the United States, you have less lenders to choose from. If you're going to buy within the United States or Puerto Rico, U.S. Virgin Islands, sometimes even the British Virgin Islands and Bahamas, there are many more lenders that will give you a boat loan for that. So it's just important to know that if you're going to be buying a boat, say in Europe, then you're going to be limited to fewer lenders, and I'll list the ones that we researched near the end of the video. Okay, so how does the loan process work? Well, you reach out to the loan broker. So you don't actually get the loan directly from a bank. You get the loan via a loan broker. I'm not 100% sure why it's set up this way, but it is just the way it works. So it's kind of like a boat broker. There is a loan broker. You talk to them, you fill out an application with them, and they shop to different banks to try to get you the loan that works for you. For us, we wanted to make sure that our loans were able to be abroad because we thought for the longest time that we'd be buying a boat in Europe. For us, that restricted us to Essex and New Coast Financial. I'll link to both of them below. Both of them are very difficult to work with in our opinion. It's kind of like you just have to put up with the nonsense they're going to put you through and be patient and keep hounding them if you're going to try to get your loan, because they're difficult, but they corner the market. You don't have much of an option. So you fill out an application with the loan broker. They go and shop it around. Once you're approved, they will approve you for a boat. So you specify on the application a boat that's more or less what you're looking for, and it doesn't have to be exact. You want to try to get pre-approved to know. You don't want nasty surprises near the end. But when we were shopping for a Lagoon 380 or a Lagoon 410 or a Fontaine Peugeot Lipari, basically a 40-ish foot catamaran that's about 10 to 15 or to 20 years old. When you get pre-approved for a specific boat, you're not married to that boat. You can then, after you're pre-approved, tell them, oh, I actually found a boat that's perfect for me. It's very similarly priced, a different model, and they'll just reapprove you. And the reapproving for the new boat is a lot easier than the first approval. After the first approval, they kind of know your financials and they just want to make sure that the new boat that you're looking at is okay. Another restriction that I forgot to mention before is that the age of the boat matters. For some lenders, they won't lend for anything that's older than 10 years old. For us, Essex would lend up to 20 years old. This boat's a 17-year-old boat, so again, Essex was the best option with regard to a boat loan for us. Also, boat loan broker is going to have requirements with regard to how the process goes when you're buying the boat. And this is kind of a hassle, but they require that you have a NAMS or SAMS accredited surveyor, that you send them a copy of the survey. So they require that your vessel be U.S. Coast Guard documented, and they also require an insurance binder. So they won't give you the money until you've proven that you intend to buy insurance and have a contract written up with an insurance broker. So they have these requirements, and honestly, you should get a survey, you should do Coast Guard or at least state registration, and you should have insurance. So all these things you should have done anyways, but having the loan broker be a part of it is kind of annoying. When you fill out the application, you want to make sure that every person who's going to own the boat or co-own the boat is on the application. This is something that almost bit us because I had been working at my job longer than Jessica had, and we were wary about that 18-month guideline with regard to job history. I also made more. Numbers-wise, my income was better, so I was the only one on the loan application. But with regard to the documentation, we were going to register Jessica as a co-owner. Once the loan broker found out about that, that was a big deal for them because they wanted to have run credit on everybody and qualified everybody who's going to own the boat. So we had to resubmit an application, re-pull credit, and then get Jessica approved to be a co-owner for the boat. Jessica's credit is better than my credit, but what you want to be careful about is if you're going to have a co-owner who's got really bad debt to income, really bad credit history, they might disqualify you from getting approved for the loan. So you have to weigh that, and maybe you don't have them as an actual co-owner. You can get co-signers in some very specific cases, but with regard to boat loans, the co-signers have to be able to qualify for the boat themselves in order to be a co-signer. It's basically if you got hit by a meteor, they could support the payments on the boat, and that's just difficult. So what did we do? Our boat cost $160,000. That's how much we paid for it. We did not have $160,000 in the bank, so we needed to have a loan. We also wanted to make sure that we had money after we bought the boat to work on it and move it around and do all the things we needed, and money for the survey. So we did go through Essex, and we got the biggest loan that they would give us. We actually tried initially for, I think, $150,000 and got denied. We went back later and got the $40,000 loan. So that meant that we just had to scrounge up the last $120,000 for the boat. So the way we went about that is two ways. One, Jessica got a personal loan because, like I said, her credit was really good. So Jessica got a $25,000 personal loan, but the term was only 3 years, and that's the downside there, is that the personal loans have shorter terms, and the boat loans have 10 or 15 or even 20-year terms, which means your monthly payment's shorter. But it was an option, and we could afford it. So we had $25,000 plus the $40,000, that's $65,000. Now we just need to scrounge up the rest of the money, the $95,000 that we had left to pay. We had been saving money for 2 years, so by the time we bought the boat, we actually had $100,000 in the bank. And that was a big deal for us. We didn't want to spend all of that money, obviously, because that's our cushion and our reserve. That's like 100% all of our money from all of our accounts combined. We had $100,000. But that was a good amount of money in the bank. So during this process, I asked around to different banks about the different kinds of personal loans. I did find one bank that offers large personal lines of credit. This is something that I would have never thought to have considered, but a large personal line of credit is exactly that, but it's got a very good rate. Ultimately, we got a personal line of credit for $75,000 that is interest-only payments, and is a very good rate. It's competitive. It's exactly competitive with the boat loans and personal loans and stuff like that. So one of the benefits about that is that once you qualify for the personal line of credit, which is actually easier to qualify for than the boat loan. So if you qualify for the boat loan, you definitely qualify for the personal line of credit, at least in our scenario. With a personal line of credit, they didn't care how we used it. I told them I was going to buy a boat, but as long as I qualified initially, there was no stipulations. From their point of view, they didn't care if it was Coast Guard registered or if it was bought abroad or anything like that. They just qualified you based on your relationship with them. Now, to get these large personal lines of credit, it's good to have a relationship with a particular bank, and that's one of the things we had to do. We actually had to open an account, start using the account, and let a number of months go by before we could actually qualify for the large personal line of credit. So you want to start this process early. Find a bank that you know you're going to want to get a loan from down the road and start building a relationship with them. If you can, ideally what we would have done is we would have bought, had we known initially what we know now, we probably would have bought a house in Austin and lived in the house for 2 years. And that would have given us a large installment loan history that would have looked very stable. We just didn't know that that was going to be such a sticking point. So we had the $75,000 personal line of credit, Jessica's $25,000 personal loan, and the $40,000 from Essex. So that's $140,000 worth of loan, and we had $100,000 in the bank. So in theory, we could have just paid $20,000 in cash for the boat and had 80 grand in the bank left over, but we didn't go that route because we don't want that much debt lingering. So what we did do is we paid off the $25,000 for Jessica's personal loan because I had the shortest term and the highest rate, even though it was still a pretty good rate. So after all is said and done, we basically put 30% down in cash on the boat instead of the 20%, and we have about $115,000 in debt. Now we have cash left over. It's not quite the math because we had the survey and the traveling, and we've already spent a fair bit of money on the boat with regard to upgrades and stuff like that. So it's good that we had a cushion because we've definitely been dipping into the cushion for the upgrades for the boat, for the various upgrades. But ultimately, 30% down and $115,000 in debt. And once we get a little bit more stable, we're actually probably going to pay off some of the personal line of credit, so we're not carrying so much there. But in the meantime, because it's interest only, our monthly payments are like $300. I mean, yeah, sure, we're paying $300, and that's just going to the bank. That's not paying down the principal, but we have a little bit of, grace period that allows us to breathe before we start paying it back in earnest. And we're going to pay it back in earnest. We don't want to carry the debt, but we had to use the debt to enable us to get to be on the boat right now. So ultimately, it was kind of a hassle. It was 3 loans, and we went multiple rounds with Essex. We went multiple rounds with New Coast Financial. And to be honest, none of them had great customer service. Essex, the first time we went through Essex, the customer service was horrendous. It was terrible. Like, if you look up Essex for Yelp and stuff like that, they have a ton of 1-star reviews, and it completely makes sense. But we did get redirected to somebody in California who wasn't. Essex has territories, and the Texas territory guys were terrible. But we got redirected from somebody from the West Coast territory. If you message us, I'll send you his information. And while he wasn't like super duper friendly, he did respond fairly timely to most of our emails and did ultimately get the job done. So if I had to recommend him, he's the less of all the evil that's out there for the loan brokers. But that's a lot. It is a lot of info. Basically, what I want to illustrate here is, don't be like us starting out when we thought we just needed 20% down and we could get a $300,000 boat because we had great debt to income and healthy income and good credit scores. That's not how it works. All right, camera died again. Switch to a different camera. We've not gotten a home mortgage before, but from everyone we've talked to, getting a boat loan is much more difficult than getting a home mortgage. I would definitely encourage you to explore other options like personal loans, even though they have shorter terms, or personal lines of credit if you can build a relationship with the bank, or plan far enough out to where you can build up a large loan history, get your debt to income ratio down, and really get your credit score squared away. We've heard of a number of stories from people who basically had to abandon their short-term dreams of doing cruising because they couldn't afford the loans. And it's not that you can't afford the loans, it's that you can't qualify because they're so stringent about the qualifications for a boat loan. Ideally, yes, we didn't want to use any debt at all, but this way we do build a history with regard to paying back these larger loan amounts, so that'll help us in the future. For a lot of us, loans are a necessary evil, and if you do it right, they are a tool that can be used. If you use them effectively and responsibly, they can enable your dreams rather than hinder you. You just have to be careful and do your homework so you're not setting yourself up for failure in the future. I hope this helps. Put questions below. Please like and subscribe if you liked it and want to see more of our videos. We have sailing vlogs coming out pretty soon.